Hello and welcome to SwitzerTV Investing. I'm Peter Switzer. And on tonight's show, we look at stocks that we expect to do well over the next year when a vaccine will help stimulus create a strong economic rebound of the Australian and global economies. But we do talk to stock market legend American Jim Rogers, who of late always seems to be bearish, and I flesh out what we should be nervous about if you are a bit of a nervous investor. In contrast, one of Australia's best bond fund managers, Chris Joy of Coolabah Capital, likes the economy in 2021, house prices as well, and the outlook for the banks. And our own Paul Rickard goes deep on whether the banks are still a good buy after a nice run in recent times, which we did tip here strongly at the Switch Report and on this program. In addition, Shaw and Partners Adam Dawes looks at the recent IPOs of Zebit and Adore Beauty. Are they good buys or should we basically wave them goodbye? And Julia Lee looks at BlueScope, Megaport and Mesoblast and a whole pile of very interesting stocks. So let's get on with the show and cross to Julia Lee of Berman Invest. Well, as always, we catch up with Julia Lee from Berman Invest to see what's interesting on the markets and what some of the hot stocks are doing. And one very interesting development is that some stocks today actually lost out because it was announced that Victoria is heading towards a reopening of sorts. Julia.
Congratulations to Victorians, reopening of the economy, being able to go back to retail, cafes, hospitality in a couple of days. And of course, that means that some of those stocks which have been benefiting from the lockdown, in particular e-commerce players, have been sold down quite considerably. Doesn't help that in some of these we have seen owners selling down some of their stakes or insiders selling down stakes. So we have seen big movements today. Adore Beauty was down by 15%. We also saw Marley Spoon coming back online after a capital raising, and that was down by 30%. But all across the e-commerce area, whether it's Temple & Webster, Kogan, Zip Money, all fell around about 5 to 7% on the market today. So I guess the key question is, if you're an investor, how do you position yourself for the reopening trade? And hopefully you've already started to position yourself for the post-COVID-19 trade. So things like travel and hospitality will once again be in the spotlight. I think one of the key things to be watching this week is that we could possibly see the pricing on the world's biggest IPO, and that is the Ant Group. Now, the Ant Group started as a payments company out of Alibaba, but now it's the most valuable fintech in the world, and it could be the biggest IPO, surpassing that of Saudi's Aramco, which was at about $30 billion last December. So this one could be valued up to $35 billion. And the reason I say watch out for it is because sometimes these big IPOs happen at the top of the market. It certainly was the case when we look at Saudi's Aramco and the oil price. And, you know, even if we have a look at things closer to home, when we saw the Lowrys offloading Westfield. So just watching that tech space, which has been a very hot space to be in COVID-19, and tech investors have done extremely well. Yeah.
Let's just talk about, I'm interested, has a company like Tyro done okay today? I would have thought the opening up of Victoria and people going out and going back to cafes and pubs, they would have been using their credit cards. Has Tyro benefited from that today?
Pete, I think a lot of companies just got so caught up in the sell down. It was throwing the baby out with the bathwater today. So Tyro was down. We also saw a number of other retailers down. And I guess a case in point is Nick Scali, which actually came out with a profit upgrade today, saying that previously it had been forecasting that first half profit would be up by a huge 50 to 60%, but in actual fact, they now expect it to be up 60 to 70%, and still the shares were down by 6%. So it was a case of Baby Bunting being sold off, City Chick being sold off, Nick Scali, despite the profit upgrade, being sold off. We even saw Adairs, which came out with some good sales numbers, being sold off today. So lots of opportunities out there, and unfortunately Tyro, which should benefiting from economies opening up and states reopening, was actually trading down today on the market.
Sounds like buying opportunity time for me, Julia. A couple of ones people would love me to ask you about. Mesoblast being threatened with being sued by these unstable Americans. What do you think about that?
It's obviously a negative, and I guess when I look at things that impact on share prices, I look at things in the category of, is it something that's going to last for a while or forever, or is it a one-off? And in the case of something like a court case or being sued, it is a negative, but it is a once-off. It's not something that really impacts on the underlying business. So while it is a negative, I think the more important thing for Mesoblast is getting through the phase 3 of its lower back pain, also its chronic heart failure, the COVID trial that it has on at the moment, as well as trying to sort out the acute graft versus host in pediatric use. So there's plenty for Mesoblast to do. It is a negative being sued, but I think the bigger question for investors to be watching is what's happening in terms of the underlying business, and is it moving in the right direction?
Okay, yeah, I know it's always hard, but if someone said, well, I bought this after it sold off, I'm happy to hold it for a year or two. Do you think in a year or two they're going to be happy?
Look, it's always a higher risk play going into something that's novel like Mesoblast's products, but I do like Mesoblast. The reason for that is that there are plenty of biotechs that I like on the market, but I know that going through phase 1, phase 2, phase 3, this is an almost decade process for most biotech companies. So I like companies at that inflection point when they're moving to phase 3 into commercialization. It means that you don't have to wait the 10 years till you start to see revenue coming in through the door. And really with Remestemcel-L, they're already selling this in Japan under the banner of Temcel. So Temcel is already being sold in Japan. It's just a matter of being able to commercialize in the US now.
Okay, those annoying Americans getting in the way. All right, and finally, Megaport. A lot of people don't understand Megaport. I know a lot of people like you. Michael Wayne likes it as well. But yes, last week it was down 11%. What was the story there?
Look, we hold Megaport in the portfolio. We did see some bad news last week. In fact, we saw some disappointing numbers come through, and this is a high growth company. So as soon as you start to see growth sort of stagnating, then you start to see the share price being impacted negatively. But I think the key here is to compare the business conditions for Megaport from the fourth quarter of the year to the first quarter of the year, and then what the second quarter is likely to look like as well. It has signed up with a new product, so that should start to improve the second quarter revenues, and I think the second quarter, the next quarter will be much better in terms of reporting. So I'm still willing to wait around for Megaport given that structural trend that we are seeing towards data come through, but if we don't see an improvement in the next quarter, I will start to lighten up the position. So I guess the big disappointments in our portfolio this month have been Mesoblast as well as Megaport. On the flip side, though, we've seen a profit upgrade coming through from BlueScope Steel, which is our largest position. We've seen Linus doing well on the market, and Helios also coming out with a very positive update.
Yeah, and I know you wrote about BlueScope for the Switzer report today. You tipped it a couple of months ago. It was very good. What's the bright aspect of BlueScope's outlook?
If we have a look at BlueScope, it's really a leader here in Australia in terms of building products. And look, Australia's housing market has held up fairly well, and that's been a big reason why we have seen that update in BlueScope and the big jump in share price. Now, we have seen that big jump in share price, but I still think that we could see an upgrade to BlueScope's guidance, which would be another catalyst. But also, you know, Pete, I like to link what's happening in one company to what might be happening in other companies as well. And one of the things that has been helping BlueScope is steel spreads. Steel prices have been improving in North America. So another company that I've jumped onto is Sims Group, which looks at scrap metals. Given that we have seen steel prices improving, we should see that scrap price improving for steel as well, which means higher margins and greater profitability for Sims Group. So happy with Sims Group, and also just having a look at some of those other Australian exposed building companies. So we're involved in CSR and just watching Boral's update at its AGM tomorrow. So I think there's plenty of look through BlueScope's profit upgrade that we saw last week, and just having a look for some of the implications for other companies that are listed on the ASX from that announcement.
Julia, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's Quality Global Growth Strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
So joining me on the Switzer Show is Jim Rogers. Jim is a legendary US investor who has been based in Singapore. I know he's shaking his head as I said legendary investor, but somewhere along the line, Jim, maybe because of your age, people have often thrown the word legendary investor in there. I'm going to ask you why you are in a moment, but welcome to the show.
I consider myself a simple person, Peter. I have seen a lot of the world. I like adventure, and for me, investing is also adventure. So I'm really just a simple person. Okay. And I love Australia.
All right. Now, but the publicity guy, who I know very well, Max Markson, has said he's been called the Indiana Jones of investing. Now, I've watched your work for years, and I've never once heard anyone say that. But I guess there must have been at least one story written about you where they linked you to Harrison Ford.
Well, there was Time magazine, which is a big big American magazine, once did a story about me and called me the Indiana Jones of finance. Peter, it was back in the day, you know, most people in the old days, if you invested in Europe, they thought you were doing something exotic. Right. So, no, I've been investing in, quote, exotic places for a long, long time. Now, many people do it. Yeah. But in the old days, most people couldn't find Portugal on a map.
Well, the funny thing is that, as I say, and I do know you are legendary in terms of people do know you well, and you are often sought out by media outlets for commentary. But in recent years, a lot of my colleagues on the Sky Business Channel have interviewed you. And when I heard Indiana Jones, I actually put there and the Temple of Doom, because you had been very negative in recent years, and you've seemingly, the stories I've read, you've gone very much towards gold. Is that a fair call, or have you been optimistic in some areas and I've just missed it, apart from gold?
I'm afraid you've just missed some of it. I'm glad to say, Peter, that you have other things to do than follow what I'm doing. I've been extremely optimistic about some things in the past few years. Russia, for instance, I've been wildly bullish on. At the moment, I'm very bullish on Japan, China, Russia. But you probably don't know that because you don't pay attention. I own a lot of gold and silver, but I did not own gold, buy gold between 2000 and 2019. But starting last year, I started buying gold and silver again. But these are things, I mean, I'm glad to see, Peter, that you don't pay too much attention to me. No. But these are things that I have done and am doing.
Okay. And I've got to say to you, Jim, because I'm an arch optimist, as I'm an arch optimist, I guess I do locate or pick up people who are being excessively negative. But you know, your gold call was right. And even though I could say to you, and I'd love your reaction, that in a sense you have been helped out by the pandemic, but I figure you were looking at gold from a point of view that the monetary policy around the world was getting out of control even before the pandemic.
You're exactly right, Peter. See, that's why you're good at what you do. That people should watch Switzer on TV. That's you get the answers. Yes, I mean, you can see this has never happened in world history. What's happening now, the amounts of money that are being printed and borrowed and spent, this has never, ever happened in history, Peter. And I know enough history to know that this is going to end badly. And politicians and academics tell us, oh, gold is a waste. Don't bother. But Peter, all of us old peasants know that when things go bad, you better own some gold and you better own some silver. So I'm an old peasant. I don't pay attention to the politicians and the academics. I know it's going to do well in the next few years.
Jim, one thing both you and I would never have thought of is interest rates getting so low and central banks basically telling us we're going to keep it lower for longer. Once upon a time, central banks wouldn't give us those kinds of heads up. Do you think there's 2 or 3 years of growth related to both the excessive stimulus from governments right around the world and low interest rates, but then there will be a day of reckoning somewhere down the track?
Well, there always has been, Peter. I mean, you're experienced enough and smart enough to know that. That does not mean there cannot be a bubble or a blow-off but between now and then. But throughout history, when you've had periods like this, well, first of all, it does often lead to a blow-off, a bubble, and it could now. Lots of new people are pouring into the markets for whatever reason. If it ends in a blow-off, in a blow-up, the blow-off might lead to a blow-up. Then we're all going to suffer very, very badly, because these rates, interest rates, have never been this low in history, and it cannot last.
Yeah, and that's the point, isn't it, Jim? That eventually inflation will creep in because there's so much money around, and then central banks will be forced to raise interest rates, and maybe the first couple of rises will be manageable, but the more rises we see, that's when economies will be threatened.
If and when it happens, and it will, as you rightfully point out. But actually, Peter, one thing in that kind of environment, the first interest rate that rises, people say, "Wow, that's great! Buy more stocks," because they say things are coming under control. So be worried. Be prepared, and then be worried.
One of the interesting stories that you basically hinted at then, Jim, was there's new people coming into the market, and we've never seen new people come into the stock market like ever before. And I blame the internet, because everyone's being educated. People like you and me have been on TV talking about money, and money's become attractive, and so young people have learnt about it. But B, house prices are so expensive and interest rates are so low, they can't even actually get their money to buy a house. So therefore they're using the stock market as a means to build wealth to eventually probably buy a property. Is that a fair call, do you think?
Well, Peter, throughout history, bubbles wipe out two sets of people. First of all, they wipe out the skeptics who know there's something wrong. Then they wipe out the believers who think this is going to go on forever. So, I mean, I'm old enough to have seen it before. I've read about it all over the world throughout history, and that's what's happening now. It doesn't have to end in a collapse, but it often has, because every time people will tell you, these are very dangerous words, Peter, this time it's different. Remember those very dangerous words, that this time it's different. It's not ever different.
No.
Bubbles are bubbles. Bad investment is bad investment. Just be aware, read some history so you understand.
So let me ask you to be 100% honest, and I know that's something that you've been known to have been. Very smart people like Mr. Grantham have been tipping house price bubble in Australia will eventually come back to haunt us. Have you been a person concerned about house prices in Australia?
Of course I have. I've even had Australian politicians tell me, don't worry, it's different this time. So it scares me a lot. I mean, Peter, doesn't it scare you to see what's happening? And you remember in Perth 3 or 4 years ago, nobody could afford a house. And believe it or not, prices went down. Last time I was in Perth, the whole city was for sale. So none of this lasts forever, whether it's America, Germany, Australia, whatever it is. Just be aware that none of this lasts forever, especially when people say this is perfect.
Yeah. One thing we have seen is that the actual management of monetary and fiscal policy seemingly looks better. Like, for example, America went into the Great Recession after what we call the global financial crisis crash. But as you know, and you can remember, it took American politicians and the US central bank nearly a year and a half to respond to the problems that it was basically in March of 2009, they started getting their policies together and we started to see the US market rebound out of that. I'll pick up on that. We saw the US market rebound. This time, you and I, we've never seen central banks and governments respond so quickly to an economic threat like this.
Peter, no one has seen anyone respond like this because it has never happened. Never happened in history. Okay,
I'll get you to pick up on that. We can't keep the sneeze in the piece. Okay, so let's go again. No one's ever seen. Yeah.
Peter, no one has ever seen this happen before because it's never happened. Never happened in history. The Bank of Japan, the guy goes to work every morning, cranks up the printing presses, and his word is, I'm going to print unlimited amounts of money. And he does it. He buys stocks, he buys bonds, he buys ETFs. He's doing everything he can. Not just Japan, but all over the world. This has never happened before, Peter.
Okay. So now I'm going to put you on the spot, and I'll give you a really easy question. How long do you think we've got until it all comes to a scary stock market collapse again, and then serious economic implications?
Well, just looking at history, I will quickly tell you, I am not shorting this at all anywhere in the world. I'm still buying in some places in the world that are depressed. Probably, though, sometime in 2021, it will start cracking in some parts of the world. And eventually, if it does turn into a bubble, it's all going to end extremely badly all over the world. There are thousands, millions of new people coming into the investment markets. That's always wonderful until it's not wonderful anymore.
So what will be the indicators that you'll be looking at really carefully to make a decision to go from being a buyer of stocks and commodities to becoming a seller? What are the key indicators?
I know the signs. I've read about too many bubbles. You know, when everybody is talking about how it's different this time, when you go see the dentist and the receptionist starts wanting to know about stocks. Oh, you know about stocks. What do you think about this one? What do you think about that one? I mean, you know I guess you know the signs. When you walk down the street in New York and the television sets are in every shop, turned on to the stock market. This is what happens in bubbles. And people will tell you it's different. Don't worry, it's different this time. It's never different this time. And all bubbles look the same. We're already seeing some of the signs in some shares in America, for instance, Alibaba in China, Amazon in America. You know, people say these stocks can never go down. They can. Don't worry, they can.
So Jim, you've got a conference coming up called the Moneyball 2021 webinar, and that's on Wednesday the 29th of October, and you can visit moneyballstream.com to register. And what will be the main messages that you'll pump out in this webinar?
My main message will be, this is a lot of fun, but be careful, because if it ends badly, it's going to hurt a lot of people. I guess my main message, Peter, now that you mentioned it, I'm going to say, it's never different this time. Participate while you can, but only participate if you know what you're doing, and be very careful.
Okay,
and
Jim.
I always say, watch Peter Switzer.
Yeah, great. And I'll tell you what, how about you do me a favour, that when you go from being cautiously bullish to a little bit scared, come back on my show.
Oh, by all means, Peter, anytime you want. I'm very keen on Australia. I'm very keen on Sydney. I'm very keen on you.
Good stuff,
Let's
mate.
do it.
Okay, matey. Thanks very much.
Thank you.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Welcome to the program, Chris.
Thanks for having me, Peter.
Historically, I've always liked to find fault with your predictions, but for the last year or so, I've been praising just about everything you've said.
Thanks.
You've had a good run for your forecasting on everything that you don't really have normal expertise in, like infection rates, death rates, and those sorts of things.
COVID-19.
Did you actually? I've actually told audiences that you actually got your really smart team to look at these sort of things because they were becoming new, critically important factors for financial markets.
Yeah, that's right. We have 25 full-time execs at Coolabah Capital, and we have a dedicated data science team who are focused on quant work and forecasting. So we have a total of 10 engineers, mathematicians, and physicists. So it was absolutely a team effort.
Now, what I'm seeing, Chris, is that your latest predictions around house prices, what you think is going to happen to even things like immigration. You got a vaccine call as well. It always seems to me to be saying that 2021 will be a better year than the mean forecast for 2021. Is that a fair call?
Yeah, we're pretty bullish on 2021. We think population growth will be better than people think. We've actually had 480,000 Australians return from overseas, and they're not currently in the resident population data. And then, Frydenberg and ScoMo, we think, will wage a war for top global talent and capital. They've already offered, I think, 5-year visas to all Hong Kong students currently in Australia. So we're definitely quite sanguine on the outlook. In March, we said the jobless rate would settle quickly between 6 and 7%. Right now, it's at 6.9. So I'm quite bullish, particularly with the advent of RBA QE and another cash rate cut, and also with the turning in the housing market.
Your view on vaccine, that is a very difficult call because who can work out the FDA? But how have you worked yourself through? Because you seem to think that by the start of 2021, people will be starting to get jabbed.
Yeah, so since February, we've argued we'll get a vaccine approved this year, which was a very unconventional view. Because I think at the time people were saying, 1.5 to 2 years. And it looks like Pfizer will be ready for an approval this year, and perhaps Moderna. And so that implies we could have jabs either at the very end of this year or in Q1 next year. So I think our vaccine calls so far are on track.
I interviewed Josh Frydenberg late last week, and he made the point. Well, I said to him, your budget is based on a vaccine by the end of the year. What happens if it's around by the middle of the year? And he says there'll be a $34 billion saving. Do you think the saving could even be bigger if it's in earlier?
Yeah, I think Josh has been very conservative with his budget forecasts. His commodity price assumptions are very low. And like ScoMo before him, I think the budget deficits are going to be much smaller than they expect. I think the jobless rate will be lower. I think the house price falls will be much lower. In March this year, we said that house prices would only fall by 0 to 5%. They've fallen 2.8. We said in March this year that the housing market would turn in September, and it started turning in September. So 6 of the 8 capital cities recorded house price rises in September. In October, we have house price gains in every city except Melbourne.
Okay, so it's not easy to put a number, but you don't do it easy without any problems. You find hard, fantastic. The growth rate for 2021, how good is it going to be?
In terms of house prices?
No, economic growth.
I think the rebound will be very, very strong. So it wouldn't surprise me to see real GDP growth of potentially as much as 4 to 5% in the 2021 financial year. Or actually, I think that would be the calendar year, 2021. And in terms of housing, we've been on the record since March saying that when the market turns, we expect house price growth of 10 to 20% over the next few years. And I actually think we'll test the upper range of that forecast. But thus far, the portents are pretty promising. And it's not surprising. I mean, gross rental yields in most cities are around 5%. Mortgage repayment costs are around 2.5%, and TD rates are below 1%. So I think all the conditions there are there for a very, very strong housing recovery. And I'm actually just surprised that so many analysts got it wrong. That all the banks calling for 10, 15, 20, 30% house price
But you
falls.
enjoyed pointing that out in your
I
call.
did, but to only get house price declines of 2.8. Again, consistent with our expectations, but it once again proves how interest rate sensitive or elastic the residential market is. But make no mistake, I think we could get better population growth than we're anticipating, or the budget is forecasting. And that's because I think you're going to see a lot of Australians come home. But I think you're going to see a flight of people and capital to Australia.
Yeah.
People shifting out of Taiwan, Hong Kong, mainland China, back from the US and Europe. I think you're going to see huge expat and new migrant influxes, particularly once we have the quarantining system set up to cope with that velocity, and especially if we do indeed see vaccines, as we expect relatively soon. And that will drive a lot of demand. There's a great example in Vaucluse. A property went to auction. The reserve was 14 mil. I think it sold for 24.6.
Is that what you paid for it?
What's that?
Is that what you paid for it?
So 10 million above the reserve, and 22 of the 25 contracts I heard were Chinese buyers.
Yeah.
So I think you're going to see a lot of Asian demand. And I think the Aussie economy, barring any sort of left field, left tail risks, is going to perform really well in 2021.
Okay, now I know I can't draw you into views on the stock market, but
Well, actually, you can. I can disclose, because I have already, we are actually long bank stocks.
Yeah, so exactly what I want to talk to you about. Do you think then that the bank's ability to pay better dividends than they did in 2020 is likely to show up in 2021 and then definitely 2022?
100%. I mean, we've made really good money. We bought ANZ, NAB, and Westpac at about...
Because you've read the Switzer report, we've been tipping that as well.
That's
so
right.
Go ahead.
At about 0.7 to 0.8 times book value. Historically, Australian banks have traded at a big multiple to book. And we did that a month or two ago for a super fund client of ours. We run something called a full capital structure portfolio, where we can invest in senior bonds, subordinated securities and hybrids, and equities. So I think that you're going to see the bank's dividends start to normalise next year, and I think they've been far too conservative with their provisions for bad debts. So I think you're going to see write-ups. CBA, for example, in making those provisions, it assumed house prices fell 12%. Again, they've only fallen 2.8%. And it assumed the jobless rate was at 9%. It's at 6.9%. Again, in March, we said it had settled between 6 and 7. I was actually talking to Matt Common yesterday about this, and there's no doubt, I mean, he's come out and said they got the housing market totally wrong, and they're much, much more bullish. But you can now get, again, positive gearing on, I think the second leg to this will be the apartment boom. So right now the housing market is ripping in at detached houses, and actually at the upper end of the market. You're seeing also very strong first-time buyer demand. The apartment market's been very weak, but with TD rates at 0.6, 0.8%, and a 5% gross rental yield to circa 6% in some cities, you're going to see that apartment market absolutely, I think, roar next year. which will, I think, provide for a dual tailwind. I've written regularly that the RBA actually published a housing market model in January last year, and they said for every 1 percentage point drop in mortgage rates that's permanent, house prices would need to rise 28%. Now, in April last year, when prices were falling, we said prices would rise 10%. No other analysts in the market had that view. They started increasing in June, and they actually jumped 10%. And I think they've obviously fallen about 3%. So net, we're only up 7%. But that's up actually after house prices nationally fell 10% between 2017 and 2019. So we actually haven't had any net house price growth since early 2017. So I think you're going to see a big boom, and we're saying at least 10 to 20, but it could easily be more than that.
For apartments?
No, for the overall market, but I think the laggard thus far has been for apartments. Coming back to the banks, I'm very bullish bank equities. I think they're going to start trading back to 1.5 times to 2 times book, with the exception of CBA. CBA has been the very expensive bank. I think it's trading about 1.8 times book. So the cheap banks in our view are ANZ, NAB and Westpac. But this isn't personal financial advice.
No.
Go speak to
it's just brilliant financial education. All right, one last question then. Your beat is interest rates, the bond market. Your scenario for 2021 is much more bullish than most economists out there. Does that mean that inflation and interest rates could start sneaking up in 2022? Because there's a belief out there it's 3 years of really low interest rates.
No, the RBA has... I do think that this ends in an inflation cycle. But that's probably, somewhere between 5 and 15 years down the track. The RBA has said it's not going to consider lifting rates until inflation is comfortably in its 2 to 3 target band. And over the last 12 months, inflation's been negative at the headline level. So we've got a ways to go. It also won't lift rates until the labour market is tight and the jobless rate is probably around 4%, and we're currently around 7%. So I don't think we need to worry about rate rises for years. And I think the RBA is going to let the economy overheat. But what does that mean for my market? So we run about 6.8 billion in bonds right now. There are expensive areas and there are cheap areas, like the share market. So, one thing that we own right now is semi-government bonds. So bonds issued by the states. They look very cheap. And if the RBA does QE, they will probably start buying those bonds. So we like that sector. We think senior bonds issued by the banks are very expensive. Their spreads are the lowest they've been since 2007. But the subordinated bonds they issue and the hybrids look very cheap. So we think there are lots of opportunities in our market. And generally, if the banks are doing well and their equity is performing, you would expect to see their credit spreads tightening. That means that we expect to see their subordinated bonds and their hybrids perform. So in our portfolios right now, we're focused on AAA rated state government bonds, bank subdebt, bank hybrids, and in one particular strategy, bank equities.
Chris Joy, thanks for joining us.
Thank you.
Joining me on the show is Adam Dawes from Shaw and Partners. Hi Adam, how are you going?
Really well, thanks, Peter. How about yourself?
Very good. Tell us about the market today.
Bit of a lackluster day today. Not much going on. Banks weren't too not much going on at all. It's been a little bit unusual to say. Resources aren't doing much. Banks aren't doing much. Healthcare not doing much. So yeah, steady as she goes until the 3rd of November, which we all know is the election that's going to stop the nation.
Yes. So we've got the election. we've got stimulus talk, we've got vaccine anxiety, or fingers crossed.
Yeah.
I guess if we get all three coming out with outcomes that the market likes, there could be another serious leg up, couldn't there?
Yeah, absolutely. And it's just like a Hollywood movie. We've got intrigue, we've got drama, we've got everything that's going on at the moment, and it fits perfectly within Trump's overall mandate to keep everybody guessing. So yeah, vaccine certainly will be a big thing to get this market moving.
Yeah. Let's go to some of the recent IPOs, and because I know you're a high fashion man, Adore Beauty would have been a very important one for you. What's going on there?
Hair care is always important to you as well, Peter.
Oh, well done, you nasty piece of business. All right, let's go to it. Adore Beauty, nice start, but it's under a bit of pressure at the moment.
Yeah, it certainly is today. Look, last week it listed on Friday. The stock was up 9% on listing, but finished up around 2%. Today, the stock is down around about 15%. So I suspect a little bit of selling, and I think that's got a lot to do with what's happening with Kogan, Temple and Webster today, which are both down. And plus also we've had updates from Adair as well as Nick Scali. So potentially that COVID sugar hit, or that stimulus that's potentially flowing through into those retail stocks, is now potentially starting to finish. So yeah, it's a bit of a tough one at the moment.
Yeah, are you a great believer that over the next year there will be a rotation to ignored stocks or rubbished stocks because of coronavirus?
Yeah, well, you mean value stocks? Is that what
yes.
you're
Well, the word rubbish and value have been hand in hand for about the last 5 years, unfortunately, but yeah.
Yeah, well, you can talk about Coca-Cola today,
Yeah.
getting a nice little leg up, and something that's been rubbished or ignored for a long time now, and it's potentially getting a little bit of a lift. Yeah, I do think that there will be some kind of, day in the sun for a lot of these stocks that have been fallen off, pulled back. I mean, we've seen the building stocks had a bit of a run over the last couple of months or last couple of weeks. That's now starting to sort of even out. So yeah, there will be that kind of play back to those more value propositions. The supermarket stocks or the consumer staple stocks, they've had their good run. They've started to pull back as well. So yeah, it's that sugar hit that potentially is now starting to wane in our market.
Talk about Zebit or Zebit.
Zebit. Yeah. So listen, it's an interesting one because it's a hybrid of sort of Kogan, which is a platform to selling products, as well as a buy now, pay later business as well. So putting both of those together, you've got Zebit. It's an interesting one because it is looking at that sort of low dock or potentially forgotten area of the US market, was around about 120 million people that don't have access to a loan and struggle to find those kinds of potential loans to help them buy a coffee table / TV or whatever there is. So Zebit also listed today at $1.58. I think it finished definitely down today, and I think the market is a little bit concerned about how they're going to pay or look after their bad and doubtful debts.
Yes, it's always a challenge, that one, isn't it? Just quickly, mate, there's a few stocks that were thrown at us, Paul Rickard and myself, at the Zoom, Boom and Doom, the Boom, Doom and Zoom program. I don't even know the name of my own show, but the ooms have got me. Let's go to it. First of all, what's Shaw and Partners saying about Zip?
Yeah, look, obviously with Westpac selling out, that's been a really tough one for Zip. They have certainly struggled, and Westpac certainly made around about $366 million out of the back of that, and they've hitched their wagon to Afterpay. So it certainly looks like potentially Zip is going to find a rebase or find itself at a lower rate at the moment. Look, we're really comfortable with Zip. We've still got a buy on the stock. Shaw and Partners has a buy on the stock. I really like what Zip's done. Zip has moved into, instead of hitching their wagon on the merchant, they've hitched their wagon on the consumer. So now they've got Apple Pay or Google Pay. And so I had a client the other day said that they use Zip to buy a loaf of bread. And look, overly at the end of the day, that's going to add around about $5 billion worth of transactional value to Zip going forward. So I actually think that's a really good option for people who like to use Zip, and it is going to keep that TV or that transaction value high. So we really like Zip, still buy and still see it moving higher over the longer term.
Yeah, I must admit the connection to Visa quite excited me as well. So,
Agree.
Yep, CBA.
Look, it's going to struggle. I mean, the banks have started to run over the last couple of days. So the banks have run. So it's an interesting one. You know, home loans potentially are going to be a little bit easier. I think the banks have sort of leveled out a little bit from here. It is going to struggle CBA over time, but it is the best quality bank in our market. It did pay a dividend, will pay a dividend next half. And I think that's what investors want, is that certainty of dividends. So look, we're really comfortable. We have a buy on Zip on CBA and NAB today on the banking sector.
All right, and let me just throw it this way, because we often get preoccupied with the short term. Let's imagine you had a client and said, look, Adam, I want to buy CBA for a 3-year hold. I think the dividends will improve over time. What do you think this might be in 3 years' time?
The div?
No, the CBA, the actual share price. Where would you?
Look, CBA should theoretically be an $80 stock. I mean, you know, that's sort of where it should be, and that has traded there very comfortably before. You know, even if we sort of take where it is today and sort of halve it, it should be around $75 to $72. I think that's sort of where CBA should be. I'm really comfortable with that, and it is the best bank. So yeah, that's where I sort of think it should be in a couple of years.
Quickly, Spark Infrastructure. I want a safe stock that pays me a bit of a dividend. Is this going to fit the bill?
Yeah, absolutely. Zip.
Zip it, mate.
Zip. I got it all on my mind here. Spark Infrastructure. Spark is certainly something that can give you that growth as well as that dividend yield. The only thing that's wrong with that Spark is offering us is that potentially there's regulated electricity bills, but really going on forward from that, a lot of fund managers like that regulated side of things. They know that they are going to be out of the next 10, 20 years or so, they're going to get those dividends and they're going to get that regulated return. So yeah, Spark is a fantastic business for that defensive part of any client's portfolio.
All right, Santos, analysts think it's about 20% upside. What do you say? What do you say with Santos?
Well, I don't think oil can stay down here for too much longer. You know, we've certainly seen oil at that sort of negative, and then moving from $20 to $30 to $40. Oil should trade around that sort of $50 mark, $60 mark. So oil definitely should move higher. Santos is definitely the one that is more leveraged to that oil price. And, you know, certainly going forward, I think Santos is certainly a buy for that leverage to the oil price. Woodside's a better pick for the balance sheet and more consistency with the dividend. But certainly Santos, if you think the oil price is going high, it's definitely a buy around here.
Okay, and this is one for the thrill seekers. AUZ, Australian Mines, 0.15 cents. Someone actually asked me about this, expecting me to have an answer. I'm asking you now.
You expect me to have an answer to you as well. Look, they just did a nice little capital raise at 1.8 cents, so it's a little bit below that that range. I'm a bit cautious on this one due to the fact that I think there's over 3 billion shares on issue. So I'd be really cautious. There's too much paper floating around on this one. So it's going to take a lot of paper for it to move higher. So for me, it's definitely a hold. If not, it's a sell. But really, it is in the right space, that sort of battery minerals area. But it needs a reconstruction before I look at it anyway.
Okay. All right. Let's hope they're not papering over the cracks with all that paper. All right, Adam Dawes, thanks for joining us.
Thank you. Take care.
Now joining me now is Paul Rickard from the Switzer Report, and Paul wants to talk about the outlook for banks. Paul.
Well, you asked me a question the other day, Peter, can the banks get back to $25? And of course, we're talking about the three, you know, not the CBA, but we're talking about ANZ, Westpac.
We want CBA to go to 25.
We want CBA to go back to about $85 or $90.
Yeah.
And of course, that's where the banks were at the start of the year. ANZ, National Australia Bank, and CBA and Westpac all around $25. They got to about $27 just before when the market peaked on February the 20th. got as low back as $14. I think National Australia Bank actually got below $14 briefly. Now getting back towards the $20 level. It got to that level back in June, very briefly, Peter, for about a nanosecond again, and bounced off that. So this is the level they've got to sort of go back through. Banks have been good performers the last couple of weeks. And I guess the market's starting to reassess that on a couple of reasons. One, obviously, the question around about the whole sort of, COVID trade may not be as bad as we've all feared. Secondly, the suggestions that they may have over-provisioned because they did this when they all had a sort of a scenario based to forecasting what they'd set aside for COVID-19.
And CBA had house prices possibly falling by 30%. Like, that was Scaryville, wasn't
Yeah,
it?
and even on their base case over the next 12 months, CBA was 12%, Westpac was 10%, and some big numbers in unemployment. Now, those numbers aren't going to happen.
House prices are rising.
House prices are actually rising, so some of these forecasts are pretty big. I don't think we're going to see right backs, but in due course, that's a positive. Now, we're just about to go into bank reporting season. We have the ANZ this week. We'll have Westpac next Monday, National Australia Bank at the end of the following week. So all the banks are going to tell us, bar CBA, how they're doing. They've also got a third quarter trading update. I think there's momentum in the banks, Peter. Clearly, the budget was the signal, this change about responsible lending, but more so the government continuing to throw the money out there. That just means that that all the problems just get put off again, gives borrowers more chance to get back on top of what they're doing. And I think as we're starting to see the data, Peter, the economy is going to do a lot better than perhaps some people had feared in March, April, May.
Yeah, and if it wasn't for Victoria, I think the bank share price would be a little bit higher, Paul, because Victoria is 22% of the economy.
Yeah, so I've looked at that. I've looked at today as sort of what I think of the tailwinds and the headwinds for the bank. I think responsible lending is a big change that came out of left field. That's probably one of the most bullish factors. There's still a huge opportunity for the banks to cut costs. They really haven't focused on that too hard during the COVID-19 recession. They're well capitalised. They're not going to need to raise capital. Westpac's probably the weakest of them, but I don't think it's long before the market's talking about potentially capital returns again. That's what they were saying back in February before COVID-19 hit. Yeah. And as I said, the provisions aren't going to be as bad as they made out to be.
Okay.
Against that, the headwinds, still got pressures on NIM, still got overall pressures on revenue, and of course there's the whole fintech thing, Peter, which is coming at them as well. And some thoughts about how they respond and what the ACCC's had to say there. But clearly, the momentum is back on the banks, and I think they can get through $20. The question you asked me is, can they get through 25? I think that getting it back to the level they were before the crash is going to take more work.
Yeah. 1 year or 2 years, Paul?
Look, I think we've got to get through 21, 22, because we really won't know. I mean, the whole thing with all this thing with the virus is that because there's been so much government money thrown out through JobKeeper, JobSeeker, JobMaker, people drawing down on their super.
Tax cuts.
There haven't really been any delinquencies yet. So this is all guesswork, and a lot of this is going to take some time to play out. So the banks really won't know what sort of position they're going to be in for some time. They've done a fair bit to earn a bit more sort of improved reputations. I think a lot of the damage is behind them, and I think they can get there, but it's going to be a little while, Pete.
All right, one simple question then. If we take one of those banks you mentioned, the big three, and they're around $18, if by the end of next year they rise by $2, 2 on 18, 1/9, bit over 10%, 11 or 12%, plus franking, they're not a bad investment, are they?
Not a bad investment. And we know that at the moment we've still got the APRA cap on dividends, and that's a function of statutory profit, and that impacts people like Westpac who are, got things like the AUSTRAC fine to deal with. But that'll go at the end of the year. You've got to expect that those caps will go.
Yeah, that's right.
And I think dividends, we're going to see, one more round this coming up now of low dividends, but dividends will go back, will certainly be higher again in next year. And that's going to be a positive for a lot of bank shareholders. So bank shareholders have done it pretty tough. They've been one of the unsung victims of the COVID-19 recession.
Well, they're part of the rescue program.
And they're part of the rescue program, and I think we're starting to see a lot of the fundies and institutions look a little more positively at the banks, and that's why the prices have been going up. So the momentum is still there, Pete.
So if you want to read that and you're not a subscriber to the Switzer Report, sign up for a free 21-day trial and read the excellent work by Paul Ricard on the banks. Well, that's the show for this week. I'd like to remind you on Friday, we have our small and micro cap virtual investor day for 2020. Just click on the link in the description box below on the screen. Make sure you're there. A lot of really interesting companies presented last year on 2 separate occasions, and many of those companies and their stock prices really went well after it. So it's a good conference to find some very interesting companies.